Participants, please be advised today's presentation is being recorded. Good morning and welcome to Prospect Resources Direct OFS Investor Briefing. Managing Director of Prospect Resources, Mr. Sam Hossack, will be giving a presentation followed by a question and answer session. All participants will be muted for the duration of the presentation. At the end of the presentation, participants will have the opportunity to ask questions either by typing a question in chat or by video and audio using the raise your hand function. If you do not wish to have your image on screen during your question, please ensure you have disabled your camera prior to raising your hand. If you have raised your hand and you've asked your question, you will remain unmuted for the opportunity to ask a follow-up question. And on that note, I'd like to welcome Sam to begin his presentation. Sam, over to you.
Thanks, Andrew. A very good morning to all the investors and shareholders that have dialed in today. My name is Sam Hossack. I'm the Managing Director of Prospect Resources based here in Perth, Western Australia. It's a great opportunity today to present this Lycopodium independent feasibility study. We're calling it the Direct Optimized Feasibility Study for many reasons, but mostly it's our peak technical study. It's had major input from Lycopodium to the degree that it's been published as an independent study. So it's a great outcome for us, and it's great to be able to take you through some of the high points today. With regards to our disclaimers, please read them very carefully. Obviously, we have access to all our public information on our website, and we do encourage you to go have a look. Lots of contact information for our team, so you're able to get in touch with management and able to ask any questions that you may have. But yeah, please take a good look at the notices. So a little bit of background from our side, for those of you perhaps taking an interest for the first time. Firstly, the ongoing engagements that Prospect Resources has had with financial institutions, various funding partners, and of course access to Lycopodium, the engineering firm Lycopodium, who themselves are deeply experienced in hard rock lithium. They're situated here in Perth in Western Australia. They have a large office in Southern Africa. So they are, in our opinion, the highest expertise in hard rock lithium. They've brought all the knowledge and understand all the experiences being had by our peer group operating here in Western Australia and some in Africa. So it's really been important for us to incorporate all that feedback, all that knowledge into this feasibility study, and so that's been a great achievement for us, and we're very indebted to the hard work that Lycopodium and the long hours they've put in. I would like to just summarize very briefly. So what have the sort of key highlights been for the last couple of years? We've been very focused on the Arcadia project. We've been very focused on managing risk of that Arcadia project. And some of the sort of, shall we say, high points of what we've achieved in the last period, we've increased the resource substantially on each occasion. We've put a lot of technical work into certainty around selection of equipment, selection of assumptions, mine plans, and on each occasion that's led to an increase in the ore reserve, which is and the resource itself, which has been very pleasing and continues to place Arcadia in the globally relevant top 10 hard rock assets. Secondly, we've made a tremendous level of progress on our technical grade petalite. So this is one of our core products, and it's a highly demanded product in the technical market. So this is an important part of the global consumption of lithium products. So petalite is certainly a market we now fully understand. We describe ourselves now as specialists with expertise in that market, and we've sufficiently communicated what that market is, how it functions, and importantly, the premiums and high value that market places on petalite products. So in terms of our progress in country, we've secured the special economic zone license, which is the apex incentive within Zimbabwe. So we've remained extremely relevant in the long-term, medium to long-term plans of Zimbabwe, the nation, the economy, and their aspiration to grow to become a middle-income economy by 2030. So we've worked very extensively with the Ministry of Mines. We lead the Lithium Producers Association. We're part of a body that communicates and lobbies for the sort of, shall we say, the improved conditions of financial direct investment conditions. So the special economic zone is a very critical license and approval process for us. We've increased the ownership over the period. We previously owned 70% of the Arcadia project. Earlier this year, we increased that to 87%. Our confidence in the asset has given us the conviction to move further up the equity chain, and we're now certainly in a very, very strong position with 87%. And of course, we've also developed our relationships with the minorities who continue to work alongside us in our partnership process. This year, we've made a huge amount of progress on our, shall we say, proof of concept and operational piloting. We've installed a petalite pilot plant. We've fed that pilot plant, produced large volumes of technical grade product, which has gone into the market in Europe. So far, we've produced over 200 tons, and we've had very high results from that, very, very sort of convincing and improved recovery results from that petalite plant. So the board of Prospect has agreed to extend the operation of the pilot plant, continue to produce samples, and continue to improve our knowledge of the ore body, and importantly, build on the economic potential of the petalite plant. So just to wrap up, we've had a very productive period. We've been focused on all assets and facets of the business, particularly at Arcadia, and we've created a very compelling business case and business environment for the development of Arcadia. And this has really cornerstoned our engagements, inbound engagements from partnerships and partnership proposals. So that's a key point for us. And with that, I think I'll move on to the next slide. So in terms of the key underpinning changes on our feasibility study, the first and the most important change has been, over the last 2 to 3 months, has been a significant change in pricing. So whilst Prospect's been working on the recoveries and been working on its technical knowledge, its legislative strength in the country, we've also seen major shifts in the commodity pricing. We've seen growth in carbonate pricing. We've seen supply gaps in spodumene production. And so we do have a very compelling commodity cycle and environment, and that's really played into it. So we've worked very closely with Roskill. Roskill have now they've established themselves as one of the key commodity forecasters, particularly for lithium products, and we've utilized their pricing during our stage DFS, which came out 3 months ago. So yeah, Roskill are certainly the market specialists, in our opinion, on pricing forecasts, and they came out with a new deck in November, which has seen a sharp increase in long-term pricing. So Prospect's taken a view, in consultation with all of its partners, including Lycopodium, we've taken a view that based on some of the consensus pricing and some of the precedents of our peer group on reflecting on those long-term pricing, we've taken a midpoint between what was the Roskill pricing in September and what is the current pricing now in November, December. So we sort of would describe this as a more realistic case. It doesn't negate for the upside presented by Roskill. So we're obviously looking now at the pricing that we used for our staged feasibility, which was 3 months ago. We're describing that as a sort of low case. We're using the midpoint as our base case, and we're using Roskill's long-term pricing currently as our high case. So I think we've taken a view that it's been important to sort of build on our credibility whilst also exposing ourselves to the long-term strengths in the commodity cycle. So yeah, you can see we've touched on some of the key pricing, particularly for on the bottom left there for spodumene and for petalite, and we'll continue to see a very strong investment narrative for petalite and the premiums that are attracted in the technical market. I'd like to move now to the actual physical outcomes of the DFS. So the physical outcomes are all the parameters and outputs of the mine plan in relation to the shall we say, the flow sheet and economic model. Now, the key outcomes here is that certainly we are primed to be one of the leaders in the high quality segment of the market. So whilst there's a variety of producers, each of those producers, on the account of their geology, are producing differing grades in their concentrates. And it's on account of our specific geological mineralization that we do actually meet a higher quality specification. That's using common or consistent processing techniques as our peer group. We just have less contamination within our ore body, and that's really what we'd describe as high quality or low impurities. So talking through the physical outcomes, and just to give you some of the high points, we had looked earlier this year at the staged approach, which was, in our opinion, a far more conservative, lower risk approach. It looked at going from 1.2 million tons per annum and building on a second phase, second train, and that had a much lower capex. It had lower economic potential because it was operating at a lower throughput for a period until such time that you install and operate the second train. This direct 2.4 is far more reflective of our ambitions. It gets us straight to nameplate, getting 2.4 million tons per annum. It manages all the risks. It has a higher capital hurdle, but this is still a very, very attractive project. Certainly more attractive in the current commodity cycle than our stage approach. So this gives us a life of mine of 18 years. It doesn't account for potential expansions, which of course are always going to be the primary objective of the business during the operating phase. So yeah, we haven't increased the ore resource or reserve during this feasibility study, mostly because most of the inputs, being recoveries and process selection, have remained constant. So the major change that we could see rolling into an ore resource upgrade would be a change in pricing. We can look at that and we'll continue to look at that. But on the basis of Roskill's longer term pricing, we'd probably see a minimum of 10 to 15%, maybe higher increase in that resource. So that hasn't been the focus of this feasibility. Our feasibility here has been focused on the independence that Lycopodium bring, sort of the focus on getting capex right and bringing risks down. So yeah, so this is very attractive. We're producing very nearly 150,000 tons per year of spodumene, very nearly 100,000 tons per year of technical grade petalite, and we do also produce around 24,000 tons per year of chemical petalite. So this is petalite that is of a lower grade or a lower quality, and it's far better suited and valued in the chemical sector. So some of our petalite, around 24,000 tons, about 25% goes into the battery production sector. And again, I think we can agree that the EV narrative and the long-term commodity cycle is underpinned by massive growth in EV demand. So yeah, we feel very confident about what the sort of physical outcomes here. We haven't had the opportunity to finalize and shall we say complete the work on the pilot plant. We have done 6 months of work on the pilot plant. We're planning to do another 4 months work, But the preliminary results that we've had are, on average around 20% increase in petalite recovery versus our assumption. So, of course, we need to do a lot of independent work on that and get our engineers like Arcadia across what we're doing, and before we're in a position to define that as a definitive outcome. But what we have learned, which is no surprise to any of our management team, is that operating a pilot plant is going to teach you a huge amount about your ore body, and that opportunity to operate it, to tweak it, to have your team study it in a live operating environment has been seen an exponential growth in our, should we say, our geometallurgical knowledge set. How do we take our mineral? How do we operate our plant, and how do we increase recovery? So it's been a tremendously promising opportunity to through the pilot plant to learn a huge amount and to start to focus on all the upside that the operating environment can secure. Okay, so moving to the financial outcomes, this is obviously the key economic outcomes of the project, and our view is we've generated a series of very high margin products. The production base for them has been very promising. We've continued over the last couple of years to focus on our cost of production. We are very competitive in our cost of production against our peer group, and there has been over the period different ways to communicate our operating strengths on the low cost basis. At times we've shown an articulation where petalite's revenues are seen as a credit. In those circumstances, as a spodumene only producer, we would be absolutely the lowest cost producer. So that isn't how our mine operates. We have two commodities, and that diversity, that ability to service a smaller but more mature technical market, and as well as the booming and expanding EV market, gives us a huge amount of confidence in our financial outcomes. So I think if we maybe just focus on some of the extremely high points, so post-tax net present value, $929 million on an NPV 10 post-tax, so it's a material increase from the previous staged approach, and is extremely attractive to our shareholders, investors, and also to the partners that have entered our partnership process. Yeah. So just to focus a little bit now on the EBITDA. So again, a key metric for us, the EBITDA, $175 million post-tax, and an internal rate of return of 60%, again post-tax. So some very key, shall we say, very key, sorry, I'll just move the slide across there, apologies. So some very key outputs there that we think are very attractive, and certainly a massive improvement. So yeah, so thank you. Sorry about that, a little bit slow and flicking over there. All right, I'm going to move across now to the operating costs and to focus now on some of the inputs and how Lycopodium and Prospect have focused on the operating environment. So firstly, our life of mine C1 costs, so a sort of key metric to measure up against our previous staged OFS. So previously we were operating at $378 per ton as a cost base, a C1 cost base. That's reduced quite significantly through a single train larger flow sheet. That's $357 per ton, so very competitive. And you'll recall, flicking back to the pricing assumptions, this is a very high margin project. Yeah. So again, we've taken a very extensive review of all the quotations. We've gone through all the flow sheets assumptions, all the build assumptions, all the supply assumptions, and again, Lycopodium have access to and have maintained a very up-to-date database of all the current input pricing and costs that we require. We have also tendered all the major equipment, which has allowed us to get quite deep into the capital cost, but very deep into the operating cost as well. So we get sort of very distinct and specific operating parameters, energy consumption. So yeah, so we've attained an accuracy of 15% plus or minus, which is very promising. Yeah. So that all those inputs, particularly the assessments that we've had on all the major areas, so mining being one of the major cost centers, production being a second major cost center, and logistics being a third major cost center. You know, we've had a good look at all of those. We've brought more independence into those assessments. We've brought studies and been advised very specifically arm's length as to where the risks and opportunities lie. So this cost base, operating cost base model, has a huge degree of independence in it, which gives us the confidence and the risk management that we need to move ahead. So again, all pointing to a very strong margin and reinforcing Prospect, and particularly the Arcadia project, as a very high quality operation. Okay, capital costs. Again, I've touched on the process that Lycopodium place. We've put a huge emphasis on accuracy of capital costs. We've actually specifically increased the accuracy of the capital cost estimate from 15% down to 12%. So it's a higher level of accuracy, plus or minus 12. And the key for that is to give us that certainty that our investors and partners, funding partners, finance institutions that we're in negotiations with, give them that confidence around the reliability of the capex. So the capex is $192 million, and that's broken down on the right. You can see there's quite a substantial, shall we say, improvements against the staged approach. Overall, around 9 or 10% improvement, and that is worth focusing on for a little bit, because you know we do talk about economies of scale regularly, but building 2 projects versus building 1 project, the risks of 2 implementations, etc. We see massive efficiencies in the capex, whilst attaining a very high certainty in capital cost estimate. So we've done a huge proportion of the feed, all the necessary required design and engineering for Lycopodium to go off and undertake these assessments, get their fixed price quotes from the major equipment suppliers. So this has been a very rigorous process that Prospect's been part of, and so we feel very comfortable, confident in that $192 million US, and again, it gives us, as we'll go through the sort of key sensitivities, this project is not sensitive to capital costs, but we are the business. We want to have that confidence to go into this development phase with the knowledge that we've actually got a very high degree of certainty on where that capital cost should settle. All right. So I'd like to just summarize, and some of these are key high points. This is certainly this feasibility study is the highest technical output that this business has produced. It's relied very heavily on the independence that Lycopodium bring, the more objective view they take on assumptions and risks, and this direct DFS is by far the most attractive implementation plan. So we did say throughout this year that we'd come out with 2 options. One is the sort of go it alone staged approach that requires $142 million US for stage 1. Stage 2 is cash flow funded by the business. We released those metrics, we released that plan, and that plan continues to be what we'd call the go it alone plan. But this direct feasibility allows us to leverage the existing partners in the supply chain, the maximal impact from our inbound investor interest, And this has cemented Arcadia as a world-class long life and large-scale lithium asset. So it's really been very pleasing. So in terms of our key assumptions moving forwards, we continue to focus on the pilot plant. We cannot put a cap on the value that the pilot plant and its operations is bringing us. Every single day there's new learnings, new opportunities, and so Lycopodium are observing all of that and assisting us, and again increasing our knowledge and increasing our economic potential. The strength that this project brings, its proximity to infrastructure, the relative confidence we have around the capex, and the development phase gives us a risk-adjusted process. We've looked very carefully at all things that could go wrong, which is very important for an African-focused business, and we've reflected the fullness of that assessment in this study. In terms of leveraging this study, the study is very attractive to the partners that we have in the partnership process. We have been in receipt of 7 non-binding proposals, and we are advancing that in parallel to completing the study. So that wraps up my presentation today. Obviously, I'd like to just share with you Nick Rathjen's details. Nick manages all our investor relations. Nick also has deep insights into the technical and chemical markets. So Nick is a marketing specialist for our business, and Nick is very approachable. So please do get in touch. Yeah. So Andrew, I think I'd be quite happy to take any Q&A that you may have now.
Thank you, Sam. As a reminder, participants may now ask questions either by typing the question in chat or by raising your hand. If you've raised your hand and you're unmuted to ask your question, you will remain unmuted in case you have a follow-up question. Please ensure you introduce yourself before asking your question. And on that note, I'd like to open it up for questions. Our first question, Sam, comes from James Farr at Canaccord.
Hi, James.
Hi, Sam. Thanks for the presentation and congratulations on the study. I'm just going on to back to the pilot plant. Can you just talk through, obviously, the progress there? Obviously, everything's going well, just how it's tracking versus the study?
Yeah. So, James, we've been operating the pilot plant for 6 months. The pilot plant is shall we say, it's a proof of concept around the petalite in particular. So petalite is a less understood lithium mineral comparative to its big brother spodumene, and that's because it's far less common in its mineral presentation globally. So there are no major lithium or petalite producers in the public space. There's no major producers here in Australia, and so when we take our petalite narrative and learnings to the investors, to our finance institutions, to our partners, it's been important for us to also back up how that petalite process works. Noting that, for example, with spodumene, if you're interested in observing its operation, there's quite a number of operations that you can go to here in Western Australia, where you can observe spodumene being successfully liberated, floated, and recovered. That is not the case with petalite. There is one other producer, and that is Bakita, and that is in Zimbabwe. Bakita sort of created the market for petalite. They've been operating and supplying petalite minerals for over 40 years. Their mineral quality is almost to the same decimal point, the same as Arcadia's technical petalite. So we've been able to look carefully at the market for petalite, identify the major consumers, identify the major supply chain process. And through that, James, we've been in touch with Sibelco, who we've entered an arrangement to sell up to 100,000 tons of technical petalite per annum. So Sibelco have been involved in this process for over 40 years. They have a range of major consumers that have place a high value on petalite. They've been purchasing petalite for the last period, remembering that the technical market is many decades more mature than the EV market. So it's that process that we look very carefully at, and that process requires large volume samples in the order of 100 tons per customer, per major customer. And what we know is that there's 2 to 3 major European customers, and once they've received and homologated your product, they've actually run your product through their plant for up to a week, and they get all their own permits, environmental emissions permits, etc. Once they've homologated that product then is accepted by the majority of the technical market. So we thought, well, we need to produce large volume samples for that market. We targeted, over 200 tons, and I think by the time we finish operating the pilot plant, we will have produced, hopefully over 400 tons. And so that allows us to really push into that market our high quality technical products and to get that feedback. So yeah, those products have been produced now, and the pilot plant was designed around scale to ensure that we could actually produce those volumes. So the primary objective actually of the Petlite pilot plant was proof of concept and to meet the marketing needs of the offtake partners and the major consumers, and we were able to do that. And so yeah, it's been very pleasing to get product on the water, get it to the customers. We probably are mindful that the logistics supply chain has been heavily impacted by COVID. So those products are on the way to our customers. They haven't yet been homologated by our customers, and that's going to become a 2022 objective. And so to a degree, James, some of that is out of our control, but what's in our control is day-to-day settings and adjustments, and how we can not only demonstrate how Petlite is recovered, but also look at means to increase our knowledge and recovery potential. So yeah, we've sort of disclosed in our announcement that we've had on average an increase of around 21% in recovery, which we would describe that as fairly early stage data. We need to back that data into some lab tests, bring it back to the field, to the pilot plant, get some more confidence around it, add more parameters to it, de-risk it, put more variability into it, all the things that Lycopodium, all the strengths that Lycopodium bring. Maybe also describe them as challenges, but they are in the final outcome are very, very useful to the business. So the pilot plant has overachieved on what we'd call geometallurgical knowledge. We've increased our recovery potential. We've also shipped the product to our customers, and the early indications we've got is the customers are happy with the product. It does meet their needs, and now they need to produce or operate their plants with this product for over a week, capture all the emission data, which is part of their homologation process. So from a quality and qualification process standpoint, we've met the credentials, but to get fully homologated, there's elements of what the actual consumer have to comply with within their legislative framework. So hopefully that touches on the high points, James.
Thank you, Sam. I'd just like to remind participants they can either put their hand up if they'd like to ask a question or send through a message to the hosts in chat. And the next question comes from Mark Fiquera at Foster Stockbroking.
Hi, Mark. Are you there, Mark?
We might, Mark might be having some issues with his connection there. I've asked him to unmute, but we're unable to hear from him. Oh, there he is.
Hello. Yeah, don't know what happened there, but anyway, yeah, good result. I just had a question on the pricing. I noted in the staged OFS that the premium of technical petalite, spodumene, was 30%, whereas I note in today's announcement the life of mine premium seems to be around 50%. I was just wondering, Sam, if you could just talk me through that, the reason,
Sure.
the rationale for that increase there. Thanks.
Yeah, Mark. So as usual, there's a bit more to it than just pulling out the pricing. But what we have with spodumene is a far more transparent market. There's a bigger production base, and so dialing back 3 or 4 years, spodumene wasn't really a published pricing indice. These days, independent spodumene pricing is abundantly available. So that's been a promising improvement in the development over the last 2 to 3 years. So spodumene, we have a fairly clear and quite well-established pricing structure. Petalite is produced in lower volumes, and there isn't an independent pricing structure. So with technical grade petalite, we have what we call value in use calculations. And so we've engaged with Sibelco, we've engaged with Roskill to go into that market to look at how petalite is valued. And so petalite obviously is a composition of elements. It is obviously a mineral composition. There's lithium, there's silica, there's alumina, and there's various other elements that make up the 100% of the mineral composition. And where petalite and spodumene substantially differ, spodumene is only valued for its lithium, and there's 6% of a typical spodumene concentrate, Se6 would be Li2O, and that compares to 4% for petalite, technical petalite. The pricing structure though for spodumene is that you've got to spend a lot of money to separate the lithium from everything else and then dispose of everything else. And at the end of the lithium process of conversion or concentration for spodumene, all you're left with is the lithium mineral, the lithium product. So it is substantially different with technical grade petalite. The mineral itself is what's valued. So in the event that a technical customer was to buy petalite, they would feed it in its completeness into their glass or glass ceramic float process. That's because they require for their process the lithium, they require alumina, they require silica, and a raft of other inputs which they have to add in addition to petalite. So when you look at substituting petalite into that market, you have to understand what those customers should do in the event they can't secure petalite. And what they need to do is they need to compete for carbonates with the EV sector. Then they need to source silica, they need to source alumina, and they need to prepare it in the proportions that are very similar to petalite, if not identical, and feed from different feedstocks into their process. So petalite as a mineral is valued not only for its lithium, but also for its silica and alumina. And there are additional emission-related advantages too. So petalite in its conversion to and consumption process requires less energy than the substituted composition of products. And it also has some other advantages at fluxing. So very technical. We understand that's not going to be easily understood, but the simplistic explanation here, Mark, is that technical grade products are not only valued for the Li2O, the 4%, they're valued for their overall mineral composition, and they are devalued by any contaminants, particularly iron oxide, for which we have very, very, very low levels. So we have a product that we would describe as perfectly required by the technical market. So that accounts for the premium, Mark.
Sure. Okay. So I gather obviously with Roskill and Sibelco and yourselves, you've done the research and yeah, the value in use, I guess, goes to contribute to that premium in terms of the alumina and silica. Okay. And just one more question for me, just on the, I noted you sent the bulk sample to Sibelco. a few months ago. I was just wondering, and obviously you mentioned about the logistics issues holding up delivering of samples, but I was just wondering, you know, you mentioned 2022 to get some results there from the testing. Just wondering, you know, can you give some sort of narrow that time frame down? You know, could we expect something in, you know, the first quarter, or what's your view there? And will you wait till they complete all the results, or would you release some information in terms of progress? Thanks.
Yeah. Look, Mark, after the initial, after we overcome the sort of standard global logistics challenges, and obviously these containers are on the water. So once they arrive, we are in a much stronger position to start forecasting how the consumers are going to schedule their own work. So we obviously have Sibelco pushing that process. Sibelco also performs some work on the technical product. They pre-prepare it by grinding it and bagging it to the end customer requirements. So there's a very strong expectation that this can be achieved in the first quarter of 2022. But we do need to acknowledge that it's not in our control. We'll be pushing,
Sure.
Of course, which is what we do. But yeah.
Sure. Okay. Thanks for that.
Yeah. And Mark, you know, I would just sort of wrap up by saying the quality thresholds, i.e., does the spec meet the spec? We've been through all those gates. So we know that the customers will buy the product. We know what the customers are likely to pay for the product. And the customers now have to go through their own homologation process before they can declare that the product is homologated. So this isn't an open question of whether the petalite product does have a market or does meet the market. We've already had that question answered. Now we're trying to just get that final sign-off from the customers.
Right. Great. Thanks.
Sure.
Thanks, Mark. As a reminder, if there are any further questions, I'd like to prompt people to either put up their hand or ask a question through chat. And Sam, we have a question from Mr. Leo Beverkva.
Hi, Leo. Are you there, Leo?
Hi there, Leo. You might need to unmute. Leo might be having some technical issues there. Perhaps if you'd like to send your question through chat, Leo. Aside from Leo, Sam, we have no further questions at this stage.
All right. Maybe just give Leo another couple of moments to try to get his question across. And then otherwise, you know, we're happy to field the question on email. Let me go down to Nick's email address. Yeah, happy to pick up any Q&A.
We've just received the question from Leo. Leo asked, what is the development timeline? Okay.
That's a good question. Leo, the development timeline's around 18 months from FID. So at the point that we complete the funding, we have approximately 18 months, and that is made up of completing engineering, commencing the construction, obviously doing all the procurement. We expect to, through this feasibility process, we expect to appoint an EPCM partner. We've provisionally shortlisted that to Lycopodium Minerals, or ADP Marine, their subsidiary in Southern Africa. And yeah, we would appoint an EPCM partner who would then complete the engineering. They would give us, you know, performance security, that give us price certainty, and they would obviously, they have the credentials to build the project and turn it over to the operations team. So approximately 18 months. And I think that slide didn't quite make the cut, but it's certainly in the present. It's certainly in the announcement detail.
Thanks, Sam. At this stage,
Sure.
there are no further questions. We have another one from Leo. What are the other opportunities you are looking into on the ground there?
Besides Arcadia, so yeah, we're in just about to bring some information back to the market on all the other elements of our growth plan. So certainly Prospect has been very focused on the Arcadia lithium project over the last couple of years. We've also divested the Penelonga gold asset. We have been exploring the Chishanya rare earths prospect, and we've also in advanced negotiations on additional exploration targets. So you're right, Leo, that we're in a sharp growth phase for the business. We have a huge capability in country for exploration. We are very credentialed. Obviously, Arcadia was a discovery, so we feel we've got a leading advantage in exploration in the country. We certainly have the right momentum and relationships. So a lot of what we're trying to do now in the next phase is secure the best ground in the country. We obviously feel very confident in Zimbabwe. We've managed to show how we can make that work. So yeah, so we do have plans, Leo, and I think we need to get them to a more mature stage, complete some of those negotiations, and then bring that information to the market.
Leo has just said, thank you, Sam, for that answer. And thank you, Leo, for asking your question. Sam, we have one more question from Hamish Wagner. And his question is, do you have an estimate on timing for completion of the partnership/funding process?
Yeah, thanks. That's a good question. So we very heavily resourced up and we're pushing that process. So, but there isn't much that I can say responsibly and reasonably, except to say that it's been a very pleasing process to run. We've been very well advised by Azure Capital and Vermilion. We've managed an extensive amount of inbound interest. We've been through a very clear decision-making process to bring to the fore the most attractive partners who know who they are, and we're moving very extensively with them. So yeah, it would be, we're all looking forward to being able to put that, put more information around that. But at this stage, there's not much I can say.
Thank you, Sam.
Sure.
At this stage, there are no further questions.
All right. Well, thank you very much, Andrew, and thank you for the investors and shareholders who've taken the time to join us today. Again, just reiterating, we have a very open door policy. We do welcome investors and shareholders pretty regularly at our office, and I'm happy to talk you through any lack of clarity, any aspects that need explanation. And we really want to promote our interaction with our investors and shareholders. So please do get in touch, and thank you again.
That concludes today's investor briefing. A recording of the investor briefing will be made available on the company's website in due course. Thank you all for joining. Thank you, Sam, and you may now all disconnect.